Hi, I hope you all are well. So today I wanted to go over Neogen's financial positions, and I'm going to do that through a couple different ratios and numbers and looking at industry benchmarks and things like that. If you have any questions, let me know at the end of this. So as a whole, I just wanted to say to all of my directors here, our financial position is good. Neogen has repeatedly increased their reporting revenue compared to each previous fiscal year, and that's something to be very proud of. The next thing I wanted to look at specifically was our financial ratios. Those are incredibly important and very valuable to a company's board of directors like yourselves. They essentially give us a snapshot of performance, and they allow the company to compare our numbers to other companies in the same industry. And they are usually interpreted by reviewing raw financial data, and this, again, is just a way to gauge how well the company is doing. And the first thing I wanted to look at was liquidity. This is revealed by current and quick ratios, and based on those ratios from the most recent period I've looked at, we're in a good spot. And I'm able to make this claim because they're above 1. And this is meaning that a good chunk of our assets are able to be turned into cash. Additionally, in comparison to the industry that we're in, our benchmark is well over our competitors. We also see that our total assets are $977 million, while our liabilities are $93 million. And that's incredibly good because your assets should well exceed your liabilities. And if they're not, then we're doing something very wrong. The next thing I wanted to look at was efficiency, and this would be in relation to how we use our assets, and simply, this is a way of asset management. This is usually found through turnover ratios, and these numbers reflect how well our company uses assets to generate revenue. As a whole, a company that generates more revenue from its assets is operating more efficiently than its competitors, and they're making good use of capital. A low asset turnover ratio suggests that the company holds on to excess production capacity and has a poor inventory management. And if we're in one of those, if we're on the lesser scale, that's something that we need to fix. But looking at ours specifically, looking at fixed and total asset turnover, we sit just below the industry benchmark. And as a company, that's nothing to get super worked up about. It could be higher, because generally when we're looking at this sort of turnover, the higher the better, but it's nothing to get too upset about. The next thing I wanted to look at was financial leverage, and this is coming from debt to equity ratio and equity multiplier. Our equity multiplier as a whole is a risk indicator that measures the portion of a company's assets that are financed by a stockholder's equity rather than its debt. Our debt ratio is relatively close to the industry benchmark, while we're sitting at 0.0595%, while our benchmark is 1.9%. Again, our number for equity multiplier is sitting at 1.1, while the benchmark is 32.6. It looks scary because such a big margin, and that is something that we need to work on and look at closely to make sure that A, it doesn't get any farther marginalized, or B, it doesn't drop below the 1.1. And that's something that we're going to keep looking at and hopefully work towards. The next thing I wanted to look at was times interest earned. And for this, our number is 6.2 compared to our 21.9 industry benchmark. And time interest earns ratio is essentially a measure of the company's ability to honor its debt payments. And of course, as everyone knows, that's a huge deal. To be able to pay back debt payments is make or break in any sort of company. And in this category, the higher the number, the better. So we could do a bit better in this category, but again, there's nothing to really worry about. And again, that's something that we can continue looking at in the future. The next thing I wanted to investigate was how well all of our expenses are being contained, and this is directly rated to pre-tax profit margin. Our numbers lay a bit below the industry benchmark at 1.2%, while the industry is 5.6%. Nothing huge to worry about. As I've said before, we could do better at this. but it's nothing to be too concerned about. Just as knowledge, the pre-tax profit margin is a financial tool used to measure the operating efficiency of a company. As a whole, this means that for about every dollar we make, around 1.2% is given back to us before taxes. Lastly, I wanted to look at our overall profitability as a company, and this is related to pre-tax ROA and ROE. In both of these categories, we could vastly improve. Return on equity ROE helps investors gauge how their investments are generating income, while return on assets ROA helps investors measure how management is using its assets and resources to generate more income. Although I know Neogen is going through a lot as a company, this is something that we really need to improve, and that's something that we are going to look at incredibly closely so that we can do better at this. If you have any questions, feel free to give me an email or let me know. Thanks so much. Have a great day.